Well, we have a very special panel today, Common Sense from Uncommon Investors. And you have a full description of everyone on the panel here, so I'm not going to go into detail, but I think it's fair to say they have an enormous responsibility, and that is they all manage a great deal of money, anywhere from $20 billion to $400 billion today. And their enormous responsibility for LPs, pension funds, endowments, sovereign wealth funds, etc., is to create stability in the world by generating high rates of return. So I thought I'd start today with Jonathan Sokoloff. And Jonathan, when I think about the firm that you really built here over the last period of time, you specialized in the consumer. Now, the consumer's tastes are changing. How has your firm changed?
Well, there's some basic tenets that haven't changed. We're fundamentally a consumer-focused business. We follow a few basic ideas, including such things as the old Peter Lynch, buy what you know and understand and what you like. Jack Welch, buy number 1 or 2 in the space or don't buy anybody. And a little bit of Warren Buffett, buy good companies and work with them and kind of leave them alone a little bit and hopefully help make them better. But over the last 25 years or so, we've had to evolve and focus in different areas to follow the consumer. So just to give you a little timeline, there's 3 or 4 deals that kind of have brought our firm to where we are today. And 25 years ago, we bought a drugstore chain in Los Angeles called Thrifty Drugstores. And we bought it during the LA riots, which are 25 years ago this week. And we had to flee downtown LA from where we were negotiating with the seller, which was, of course, the local gas company that owned a drugstore, and it totally messed it up because the riots were coming when we feared for our safety. The only time in my life in LA that I really feared for my safety. And then all the stores were looted. And out of all that drama, we bought a drugstore chain. It was losing a couple of $1 million a week. We turned it around. We merged it with another chain called Payless. We sold it for a lot of money. We made a double-digit return on our equity. Fast forward from, that was 1992, 25 years ago. Fast forward to 2000, the internet boom, the dot-com boom came, and the stock market kind of lost its mind, and traditional investments were worth nothing, and dot-com was worth everything. So we bought Petco in 2000. We had a strong view on the pet space. Pets.com, which had negative gross margin, was trading at $800 million. Petco was made $100 million when we bought it for 6 times. We were in and out of the Petco investment for 16 years, exiting finally in last year, and each time we made over 5 times on our money. But now, even last week, a company called Chewy, which finally figured out the online pet business 17 years later, was sold for $3 billion to PetSmart. So the world evolves dramatically. Our next probably seminal event was during the financial crisis, where the world ended in the fall of 2008, and we made a very large investment in Whole Foods. And Whole Foods stock was down about 80%. We felt the consumer move, as we did with pets, the consumer move to healthy eating and healthy food was unstoppable, that the stock market had overreacted, so we invested in a large PIPE in Whole Foods when the world thought they were going away because no one could afford to buy anything at Whole Foods. So the stock was about 10, then the stock went to 100, and we made a great deal of money. And we exited Whole Foods about 4 years ago, and now Whole Foods is having all kinds of drama. So you can see our first few deals were retail-oriented, where today we've made a dramatic pivot. And while the majority of our consumer-related investments were retail, today the majority are consumer services and services-related. So today we're 75% services, and that could be a gym, that could be a chain of car washes, that could be a variety of healthcare services companies, because there's been a dramatic shift of the consumer buying things to buying experiences, as this chart shows. So as an investor, you can never stand still. You can never take a nap. What worked a few years ago is not going to work tomorrow. So we're always having to evolve. We're having to look around the corners and see where we think the consumer will be spending their money going forward and evolve our investments accordingly. So that's what we've done, thank God, and it's worked pretty well. So here you can just see consumer services have gone from 20% of the economy to 35%. Well, grocery, apparel, and footwear have gone from 23% to 10% over 30, 40 years. So a pretty dramatic shift in consumer buying patterns. We have to study consumer buying patterns at length to figure out where to invest our capital.
So, Steve, happy to have you with us. Happy that you can allocate some of your time to investing while you're advising the administration on so many things today. But I thought it might be interesting to just read a couple facts from your April 20th Blackstone earnings call. Our private equity funds have regularly outperformed the S&P by 700 basis points net after fees. In real estate, that outperformance is 900 basis points. In the past 3 years, Blackstone has raised $225 billion from LPs. We're basically in the intellectual capital production business. Sustaining this advantage has become mandatory to deal with geopolitical events and decisions by governments which are impacting the business environment to a greater degree than ever before. Tell us how managing Blackstone has changed and how you've built the culture of the largest firm in your area.
Well, fortunately, the firm hasn't changed enormously in terms of the general approach that we take. I'm a great believer that, sort of almost all investing is cyclical, and you have to know where you are in the cycle, and that means not just, in an industry or a country. It means all over the world. Where is everything happening? Where is it going to change? When's each industry going to start changing within that? And so we tried to build a business, since the beginning, where we started in the advisory business and then moved into private equity and then real estate and hedge funds and then into credit, where what we do is every Monday, each of those big business lines meets for like an hour and a half to 2 hours, and everyone in the group is there. I'm a great believer that if you're younger, you're just as good as anybody who's older. You just don't have as much experience, but you're just as smart, and you want to be treated as if you are, like as good as anybody in the organization, which they are. And so what we do is we go over every transaction everywhere in the world. We have an economist that is in the room. We have our sort of political advisors, and what you learn by going around through each geographic area with each deal is the relative risk reward, and it's like an education, lifetime education, as all the young people and the rest of us learn what's going on. And you could start seeing trends that start going around the world. And when you do it in multiple asset classes, there's an enormous advantage because the cycles for real estate aren't necessarily correlated one-to-one with the cycles for sort of private equity, and different countries touch each other without a one-to-one correlation, but sometimes you can see things, and we openly discuss where we are everywhere in the world all the time. And what you can do is you can start to see patterns. And so you could see there was going to be a huge real estate blow-off in 2006 because we were looking at buying some properties in Spain, and Spain was so overbuilt that you could have moved most of Germany into it, and there'd still be empty units, so Spain was going to go busted. So what happened, normal private equity people continue to invest in good companies in Spain. But if you thought Spain was going down, you don't want to be anywhere near it. And so we were able to take every one of our businesses, whether it was real estate or credit, and sell out housing. And you could do things like this, and you actually don't have to be too smart, which is a great benefit for me. because I'm not that smart. But if you set up a system that compensates for that, then you win a lot. The other thing, and I don't want to dominate this at all, you got so many great people
So
here.
Steve, if I could paraphrase, basically you're very focused on looking things from the macro standpoint, what's going on in the government, et cetera, as well as the micro, what's going on in the individual
Yeah, it's sort of a squash. You've got to
So,
look at...
Mitch, as one of the leading alternative managers with more than $20 billion in assets, and you and I have spent a lot of time intellectualizing investment, research, et cetera, together over the decades. What does common sense mean for uncommon investors? Kind of like the name of the panel was made for you, Mitch.
Thank you. Appreciate that. It always helps to play to your strength. Look, I don't know if my mom would say I have a lot of common sense, but certainly over the years, either you develop common sense because the market gives you a lot of feedback, or you have to get out of the business. And one of the things that I think Josh and I, my partner Josh Friedman and I, have learned is that the world is complex. I think we all particularly understand that since 2008. And unless you embrace that complexity and understand that complexity creates opportunity, I think that's common to the theme that John was talking about, all those different points in time where there was a tipping point, in whether it's social or economic, financial, and that represented an opportunity. But as Steve was saying, unless you bring multiple perspectives to the situation, you embrace that complexity, you recognize, as you pointed out, that you have to have a certain sense of humility, your own limits, and that through collective learning and the right corporate culture, you can embrace that complexity and then create either opportunities by designing securities that solve a problem for a company, as you did in the 80s, we all did working together, or you will find opportunities in the secondary market because, and if you could put up slide 11, I think if there was one slide I'd like to show you is this. It's that maybe it's not common sense to think of our financial system as having more holes, more gaps and cracks now than before 2008, but I believe that is the case. And in addition, if you look at the other part of that matrix, corporate balance sheets, the balance sheets of securitizations, other types of structured products, they're going through more change, and that's probably a reflection of increasing a lot of the themes at this conference: disruption, technology, et cetera, grocery businesses going through major change, retailing is going through major change, online, share a wallet, experiences versus buying stuff. So corporations can't just rely on the traditional means of creating value the old-fashioned way, good return on invested capital, growth, because they don't know sometimes they don't know their cost of capital, the right side of their balance sheet. Sometimes they don't know whether the incremental investment that they make is going to yield a great return. I'll give you one really visible example. It's right next door, Westfield, the new mall. You should go over there before you leave this conference to get an idea of what retailing, if you're going to leave your computer and you're actually going to go someplace and buy something, physically go there, you have to have like a Disney experience. Because otherwise, there's almost no reason to try to, take away the convenience of online. So there are companies out there that, and particularly mall companies, that understand that to survive, they have to change their balance sheet. They have to create this major experience. So what does that mean for us as an alternative investment manager? It means that companies are either going to try to reinvent themselves through traditional methods of deploying capital and making their cost of capital as flexible and as cheap as possible, or they're going to do other things, like they'll split up their OpCo from their PropCo. They'll go public or they'll go private. They'll take on debt, they'll take on equity. They'll issue converts. All those major balance sheet changes are occurring at a greater pace, but yet the gaps and cracks in the financial system are more and deeper. So that means there's a structural basis for alternative asset managers like us to play. And then one last thing I'll say on that issue. You can see that particularly a very, very clear example of that is in the case of companies that over-leverage, such as Caesars, right? So here's a company that the left side of the balance sheet, it's in the sweet spot, right? It's got a relatively controlled market because of regulation. That's the left side. It is an experiential kind of thing. It's right in the strong suit of what consumers want. Consumers are benefiting from the macro because more W-2, they're employed, their houses prices have stabilized, their 401ks have gone up in value, so their balance sheet is better. So they want the experiences, they'll go to Vegas. Vegas visitation, I think, is off the charts right now. So these key companies, including Caesars, their business is perfectly attuned to the times. The right side of the balance sheet had to go through major change. And going through that 3+ year process as a creditor, as actually, I think, either the first or second largest creditor, was a very complex thing to do. It involved not only knowing the law, but you had to understand the old expression, where you stand depends on where you sit. You had to put yourself in the position of the other people on the other side of the table.
Sounds like you studied game theory here, Mitch.
Well, I think it's common sense, right? You know, Rufus Miles, the old academic about bureaucracy, said it about politics. Where you stand depends on where you sit. I don't think that's game theory. I think that's simply common sense.
Well, we got to the title of this panel now, in case you're wondering where it came from. So just an example, I think, to reinforce Mitch. If I look at numerous companies, let's just take Singer Sewing Machine. It's January '74. They know more about the sewing machine business than anyone in the world. They've been paying dividends since 1860 or something. And they decided to dramatically expand into malls and sell fabric, vertically integrate. Interesting idea. What they didn't understand was, gosh, women are going to be working. The 1970s brought the emancipation of women. So you just didn't have to be a school teacher or a nurse. And all of a sudden, Singer, within a year, was on the verge of bankruptcy. So here's a person who knew a lot about sewing machines and supposedly customers, but didn't understand the dramatic changes. And as Steve has pointed out, what was going on in Spain and the overbuilding in Spain and the changes that were about to befall Spain from that standpoint. John, one of the things I thought might be interesting to ask you is, what's your most memorable investment? And how did it change your strategy on building a firm, running a firm, and how you spent your time?
Well, kind of looking back in history here, I got really interested in the convertible market in the 1970s. And it was really not just about convertibles. It was really, how do you manage risk? That was the whole point of, gee, how do I manage risk when the markets are as volatile as they were in the 1970s? So it was really about adapting to an environment and managing risk. And so one of the things I really studied convertibles a lot. Then the option market opened in '74. So I was selling options, managing risk with that. So that proved to be a very good performance throughout that very volatile market environment in the 1970s. Interest rates doubled, market went actually sideways for 10 years. So that was that really got me started in the convertible area, and I used that in the 80s using the options. We bought puts right before the '87 market crash. That was good. In 1999, we were looking at the market, and growth was really going well, and we always had a kind of a combination of using technical as well as fundamentals. And the fundamentals were saying, hey, these stocks are overpriced. They're going up, so we bought some puts. It didn't work the first year, but in 2000, worked really well. So the one thing that we learned over the years, market timing, short-term market timing, is very, very difficult. So kind of manage risk over a longer term.
So, John, it's interesting. I've often spoken to the group over the last 2 decades that 1974 that you mentioned, in my opinion, is the most important period to study if you want to study financial history post World War II. And with the stock market going down 50%, interest rates doubling, the convertibles that you spoke about, and not a lot of knowledge of mathematical structure of a convert back in the 70s. As we launched those markets, a convert can be equity, it can be a debt instrument, et cetera, and you have a chance to move, and you've obviously been a leader, ever since in that area. But understanding, somewhat underlining what Mitch had says, the complexity of a security, and understanding what is the implications, what is the value of the debt of that security versus the equity and the options. So, Tom, navigating around scarcity of information. You and Stephen have also taken on responsibility to interact with our federal government. You played a big role in the election of this President of the United States. And maybe you're the most international of all of us, living abroad, relationships in Asia, though Steve has launched significant programs for the Schwarzman Scholars in China, but a strong view in the Middle East, Europe, Asia, etc. How has your view of the world created you as an uncommon investor here and stood you in good state all these years?
Look, I think the bottom line is, and I think we probably all feel the same, is that I'm more humbled the further away from home that I go, and more blessed to be within a 212 or 310 area code. So no matter what we think about arbitrage, when you come back to the innate system of America, a transparent legal system, a community of interest, an American dream that can still take place, that you could have a real estate developer or a reality TV host become President of the United States. It doesn't happen elsewhere. It really doesn't. So the extent that we get hubris in thinking, something like real estate, which is, it's a slow-moving train. And when you think about real estate investment, you say, okay, well, I'm going to have an operating business of somebody who actually knows how to do something, a hotel. And a man or woman comes up with an idea, and they go find a piece of land, and that takes a couple of years, and they get an architect who designs something that's unbuildable, and that takes another couple of years, and then they find a builder who's going to build it at 3 times the cost of what you can afford, and that takes another couple of years. Then you build it, and it's 3 times over budget, and 3 times longer than it takes, 3 times longer to fill up, and you're supposed to be right on the financial market by the time you get there. It's a macro bet, right? It's just a macro bet. So I think, to me, the simplicity of having great investors such as those that are sitting in the room and certainly on this panel, creating value on things that they know and just taking arrows in those quivers in a transparent, unified community of interest like America, where you have a system that's reliable, is a gift. When we talk about the Americas, which we've talked in place, and Steve is spending a lot of his time advising the President of the administration on some of these issues, that the global issues all start with entrepreneurs and people who are willing to take risk and hire people and work for a living. It's not about investing your 401k and thinking you're going to make more money in your 401k than you do in the job that you work at. So that has to offer a platform in which people can prosper. And I think what I've learned in traveling around the world and really seeing the cultural nuances of other systems that have tremendous value is we are blessed to be able to live, work, and invest in America, and it's still the singularly best place to make money.
Now, I know I heard you say that disintermediation in real estate is one of the most drastic changes. You have been one of the world's leading and best real estate investor for decades. You know, Steve runs a very, very large, probably the largest real estate investment operation under Jonathan Gray at Blackstone. How has investing in real estate changed that you talk about disintermediation?
Well, I mean, tremendously, right? It used to be a great, if you think about it, if you think about the old families before any of us got into the business, you build a building, you borrow as much as you can for as long as you can from an insurance company, you lease it all to Xerox or IBM, and you refinance every 7 years and pull it out tax-free. What happens is IBM and Xerox go bust, then you're left with an empty office building, and you don't know what life is like until you're trying to fill up an empty office building, right? Because it's all about cash flow, CapEx. So for almost 15 years, I think we all got a little bit lost in that we became financial arbiters rather than real estate professionals. So we didn't really understand the businesses that were paying the rent as we were securitizing them and dividing them up and synchronizing them. So today, if you look at businesses that are not reliant on sticks and bricks, I mean, Jonathan does such a great job at such a complex industry, and the value and utilization of sticks and bricks in those businesses we've talked about forever. But if you look at the marketplace, you look at a company like WeWorks, which owns nothing, and the enterprise value is equivalent to Boston Properties, which is probably the best or largest office REIT in the world. So how do you justify value? Who's right, who's wrong? Who are the occupants in the high-rise buildings in downtown Los Angeles?
Right.
Are those the occupants that you want, or do you want to be in Nevada next to Elon Musk, where you're investing side by
Well,
side?
that's where I've chosen to go. So I think this issue here, I want to move it in a different direction and maybe start with Jonathan, you, Steve, and Tom on this. The second to ninth largest employer in America are now private equity firms. And there's been a dramatic change in a sense of who people are working for. Obviously, number one is Walmart, but after that, they're private equity firms, and I would guess, Steve, you probably have maybe more employees working for your companies than any private equity firm. How do you think about those things? You're an investor from that standpoint, but you're also one of the largest employers in the country. That's part one. And the second thing I want to put on the table, and we can all talk about it because it relates both to Mitch and John. When I went to Wall Street in '69, I had this idea. I said, okay, if I have better ideas, know how to finance companies better, knew and understood where the world's going more, I want to find an owner. I need to find an owner because I could motivate an owner to be my partner or financial partner in a sense that that owner wants to maximize the value of his company. And what I discovered in '69 through and even up to the early '80s is that isn't necessarily true. Steve probably remembers it best, maybe Tom also, but many of the owners in the late '60s, '70s, their pay was based on the size of their company, their amount of revenue, not their profitability. So trying to explain to them what they were doing didn't make any sense. It wasn't a strategy because for them it made sense. Increased pay, airplanes, country clubs, etc. So today you sit at the conference with more than 60 private equity firms here who control thousands of companies today, and where quite possibly the owner and the management is aligned, or the management wouldn't be working for that company. Steve or John or Tom, one of you want to start with that? Governance?
Well, look, our industry has really matured, grown up. It's an integral part of the U.S. economy. There's varying statistics how big it is, but it's a giant employer. And we've done two things, I think, over the past 30 years. One is I think we just have a better governance model than, for example, the public markets. And it's a combination of a owner-operator model, where you really want to make your management teams and yourself act like an owner, and a pretty rigorous focus on return on investment and where should you deploy your capital and how do you grow your money best. So we've been able to deliver returns for 30 years dramatically in excess of the stock market. Notwithstanding that, our industry still kind of has a lousy reputation. We're generally viewed negatively by most people who don't understand us. And what's really interesting is in our business, you know, we often meet management teams, whether they're public companies or family businesses, and they're a little skeptical on us and what we do. They're a little scared. And then they're a little scared of leverage and debt. They've been just trained naturally to not like leverage. And so what we have to do is educate them. And we walk them through presentations on how our governance model can be better, how it can be more value creating for them and their families. And the best way we have to do that is by giving them the names of the CEOs or CFOs of our portfolio and say, just call them up. Don't ask us. We obviously are good salesmen and we have an axe to grind. Call up these companies and see what they say about what it's like working for a private equity firm, perhaps what it's like working for the public. And that's our best commercial and best endorsement. And I wish we could find a way to mirror that in the more greater population or in government, because we do take our responsibilities very seriously as both stewards of capital and owners of business. We have hundreds of thousands of people that are working for us that depend on us for their livelihood. And if you look at over time, even in the financial crisis, very few private equity-owned firms in the end really got into big trouble. There was no big scandals in private equity-owned firms. And we've done a good job, and I think it's only going to get bigger. And in the meantime, we've delivered wonderful returns to the pensioners of America, the insurance companies of America, now a lot of the international players. So it's been wonderful to be part of this business for 30 years, but as much good as we've said we do, sometimes it's still very frustrating because our reputation's still kind of lousy. Now in business, sometimes you have to make difficult decisions. You have to reduce workforces sometimes. You have to close facilities, all in the hope of making a more profitable business. We've generally built our businesses through growth, through organic growth, through hiring people, through opening new units of whatever business it is, and creating value the old-fashioned way, grow the business. And it's been very rewarding and very lucrative. But notwithstanding that, our industry, we need some better PR and some help in how we market ourselves.
Steve?
Yeah, we have... at Blackstone, we're the fourth largest employers in the United States. We have currently approximately 600,000 people who work at our portfolio companies. That's just one of the 4 or 5 areas that we're in. That's not including our real estate business and so forth, which is quite large, and our other activities. So people mistake us for financial people. I don't know exactly why. If you had 600,000 employees, you might be a company, right? Like a responsible company, and that's what we are. And so the way we make money, besides trying to buy at a reasonable price, is we actually have to build our companies and grow them, as John was saying. You have to grow them faster, or as fast as they are capable of being grown. You don't sort of slice them because you can't get a multiple on that. And so our companies on average, and we're quite substantial, obviously. We have somewhere, depends on the cycle, around 125 billion of revenues. We grow 50% faster than the S&P. So that's not double, but it's at least 50% more. And we do that, through, good strategies, putting capital up, and we have a whole separate staff of people. Led by one of my partners, Dave Calhoun, who was vice chairman of General Electric. If you ever need an operator, You should hire the top people at General Electric. They're really amazing. And we have all kinds of things. We have group purchasing. If you imagine the scale that we're operating on and the kind of discounts that we can get, we do stuff in terms of buying parts with computer auctions and whatever the latest technologies are. Sometimes we can save huge amounts of money doing that with suppliers. We do healthcare across sort of this type of scale. And so when you do all of these things, and you use best practices, whether it's for the environment or whatever, as John says, the idea that you could do all that, have a great success, and be perceived like sort of at best a marginal way in terms of contributions for society, you got to really wonder who's doing the PR, in this group, because it really works like that, and it's a big responsibility, and we take that as a sort of serious business. It's not just being a genius and buying a company and playing with it. It's a lot more.
Tom?
Look, even just, I frequently get asked the question, we'll meet people, oh, you're in private equity. Oh, don't you just go in and buy companies and cut costs and then pretty them up and then flip them? That's what people ask today, 2017. And I say, no, we've never done that. We don't do that at all. We grow businesses. We create value, but most people think we do the former.
I think, John, that might be still a carryover from 30 years ago in terms of defense. When people wanted to buy the company, you're letting everyone know you're just going to let go of all the employees, et cetera. Tom, you've been on both sides in private equity, owning businesses, et cetera. How would you respond to some of the things you've heard?
I think it's all about curation, right? I mean, the reason that this group has been so successful is they're professionals that have wandered through these jungles 1,000 times, and they know how to curate people, talent, and financial platforms. Anybody who's run a public company doesn't want to do it again, right? I mean, it's really that simple. It's built for
Yet I
mediocrity.
notice, that you've now combined a lot of your entities under one public company here today.
Yeah, but it's a slow-moving train, right? To go to that framework, you're solving for mediocrity, and the market is dying for mediocrity, right? Today, the market in our business is dying for yield. Now, everybody sitting here would say, if the market is dying for yield, I don't want to be there. I want to be on residual pop. So I'd like to be involved in things that are going to give me total return, and I'll sacrifice what appears to be current yield for residual value. And the private equity sponsors today allow otherwise firms that are investing under the cracks, that are never going to reach their actuarial hurdle, to be able to avail themselves of 6 or 7 turns of debt on a really competent basis without worrying about quarterly earnings, and hire unbelievable teams of staff who are motivated the same to do the job.
Well, you just opened a whole line of discussion here that I'd like to go to Mitch first and yourself on, John. Okay, so we could suggest this is a great time for private equity. One, you're able to borrow 6 to 7 times, and you're able to borrow at rates that, if Steve and I think back to the 70s when we were both a little younger, that you say to yourself, it's unbelievable. I've borrowed it 6 to 7 times.
Yes.
I have no covenants, no maintenance covenants, and my all-in borrowing cost is 5.5%.
Pre-tax. For now.
Well, we don't know if that's pre or after. Steve's going to let us know by the end of the panel.
Yeah.
Now, Mitch, you and John are on the other side of the coin.
Right.
Okay, so they want to buy a company. They might pay 9 times. They only want to borrow 7 against it. They're willing to put up a little bit of equity, but of course they want to have room in a dividend basket and a builder so they can take all their money out soon. They want to pay you a very low rate of return, and they don't want any covenants and no maintenance. How do you generate a return as an alternative manager with that asset set?
I would give them the following advice. Try to make your company look and the securities you're going to issue in your transaction as much in conformity with what the ETFs that house high-yield securities would want. Otherwise, if you can't fit into that box, which is a very popular box that has those tight spreads and provides what Tom was saying about, the need for yield and liquidity. If you can't fit your transaction and the securities you want to issue to finance that transaction into that box, then you come to companies like ourselves.
Then they have to come to you, Mitch, right?
That's right. And that's the gaps and cracks in the system that I was referring to. And so what we have found is this bifurcation of the market, right? The popularity of ETFs and other index-oriented structures, smart beta, et cetera, means there's a crowding effect with a reinforcing kind of dynamic that overshoots on price, et cetera, because people are not buying the fundamentals, they're buying the mosaic of that kind of product. So that means there's a limited amount of the high yield and leveraged loan market that fits for that kind of product, and the rest is left open for alternative guys. So if you need to get a transaction done quickly, for example, if you see a software company where the price in the public market has collapsed by 40, 50%. Why? Because people in the marketplace can't make the complex calculation as to how long their business will last as a legacy business embedded in the infrastructure of the company versus the disintermediation of the cloud. So a private equity fund that specializes in tech will say, okay, it's not so important what my cost of borrowing, and I'll agree to tight covenants, all the opposite of what that would be wanted. But they basically understand that it's a pragmatic, right? I want to get this company. The most important thing is to buy it at a slight premium to where the price has collapsed to. Offer that to shareholders who want out. So I'll go to, let's say, 3 firms that I know have executed in the past for us or have a good reputation. So we will be on that short list. And they will say to us, okay, can you speak for $100 million, $150 million of this, whether it's a loan or a mezzanine financing? And we'll say, yes, we can. But it can't be that long term. The rate has to be close to 10% or more. It has to have non-call features. It has to give us a maintenance yield, in case you want to take us out, prematurely. And the covenants have to be pretty tight. And you have to take your cash flow and pay us down, because in our firm, our philosophy is return of money is just as important as a return on money, especially in these complex times. So we'll be able to design or find in the secondary market that kind of not on the rack, off the rack merchandise, so to speak, that will provide you with the risk return elements that you would think do not exist in this market when you look at the leveraged loan indices and the high yield indices. And by the way, just to close the loop on the real estate point, because it relates to what we're talking about here, off-market type of pricing. As you pointed out, Tom, and I think Steve, the cycles in the marketplace go at different levels, different rates of change. Real estate, for example, at the local level, goes through this long process where the developer is trying to get entitlements, works with the city. The city knows that it can't wait for the federal government to solve its problems, so it has to have a competitive model. The developer will basically get, finally, all of its ducks in a row. And then it goes to the local bank. And what does it find? The local bank is subject to Dodd-Frank and Volcker and Basel and at-risk rules. And the developer says, wait a minute, you've been able to lend me at 3%, 4% all these years. And the city has this amazing strategic plan. And you can already seize the fruits of that plan. People are coming back into the city. We have this great business cluster effect between universities, businesses, and government. So it's all working. And this project is terrific. It plays to the infrastructure leverage. And the developers and the bank says, I'm subject to, all these regs. I can't do it. So what will they do? Well, they will come to Canyon and they will say, can you,
I wondered what that line was outside there, Mitch, when we came in. I didn't know it was real estate developers in this area.
we try to develop a spectrum of products, Mike, because we're fitting needs that are out there. And if it makes sense for our investors, we'll design the right security. So in real estate, the developer has bad timing in that respect. He's got it all there, and the banks are not there. But they will be there once the project gets developed. So look at this. The developer will borrow on a senior basis, a mezzanine basis, 10, 13, whatever it is. And then in 4 years, when it's built and it's proved out, he'll be able to go back to his local bank and borrow at 3-4%. That's a major gap in the capital market. So what we have is a fund that's designed to fit that need. I don't think I'm saying anything different than what you have developed at Blackstone and what you have done along, in the real estate market. But, I think it speaks to the fact that cities are not waiting for the federal government to solve their problems. Notwithstanding the fact the federal government is increasingly affecting the risk and return of securities. So they're doing it, but they're finding that the banks are tied up. This is what I guess you're working on in this new administration, trying to be the rotor-rooter of the financial system, because with Dodd-Frank, there's been an overshoot and too much regulation.
So let's go to John. And John, if they come with a difficult deal, you'll let them know you'd love to buy it in the form of convert or a bond with warrants or preferred with warrants at this time.
Yeah, I think, as you pointed out, many, many years, Michael, convertible is all about access to capital. And the convertible structure really is, a dual benefit. In fact, as I look at private equity, many private equity investors use the convertible structure as a way to buy companies and loan money to business. So and now with the world being much more global, I think we'll see more and more convertibles in a global market as well. So that's, I think it's an important axis of capital. The problem is that it's not helping the small business. And the small business is really what creates jobs in this country. And small business relies on bank loans. And banks don't loan money out anymore.
So that's why we have this explosion of non-bank banks, right?
That's right.
It's really the money managers that are forming these institutions to loan money. And I think you can imagine how exciting it was for me in '69. There's 500 investment grade companies, umpteen million non. And the competitors didn't even want to do business with the non-investment. So it's pretty good. They've got all the companies that collectively don't create any jobs. We have all the companies that create jobs. But as you know, John, and you haven't told the group, whether it was Tesla or others, many of these companies, convertibles were a big part of their capital structure as they were built and continue to be built at that point in time. I'd like to shift the conversation a little bit, if I could here, and discuss what do you see if you were talking to the government and giving them common sense? Now, we have secretaries of the cabinet that maybe more than every time in history, and I can't measure that, Stephen or Tom, that they were successful in the private industry, that today have cabinet posts. They might not have had common sense in a sense of politics, so they're neophytes in politics, but they have a great deal of common sense in what works in their business and what doesn't work in their business. How does your interaction when you go to the meetings with the administration and group, and we don't have to go into any details, Stephen, how does that compare to your interaction when you have those meetings with your partners worldwide and discuss the businesses you own? How does that compare?
I'd say it's really similar. I mean, you've got people with similar experiences sitting around a table. They're really forget what their titles are. They're anxious to just get the economy going again, and they look at all the inhibitors from doing that. And if if you can help them, think through which one to attack first and what you would do, sort of breaks into different piles. You've got the stuff that they can do themselves as the administration from a regulatory perspective and getting rid of those types of restraints to the extent it's safe to do that, and it's happening all over the government. And I think it's very hospitable, and it's quite non-ideological. It's very pragmatic and practical, and if you put something on the table that is going to work, everybody gets excited about it and says, let's go and do it. So it's different. I've been involved tangentially with other administrations, and so have many people in the room, and sometimes there's a lot of talking or well-meaning something or another, but it's not a group of people who wants to go through and actually make it happen, and this group does, and it's very similar to a lot of the people sitting here.
Right, I think that's a very interesting analogy, that the team that you have in the group under you that's interacting, they're busy. They're really busy. They have a lot of responsibilities, and they've allocated that time, as you have. And they want to make something happen, which is similar here. I think most people want to see what can they do, no matter whether it's improving the economy, whether it's improving other factors.
Well, what we do with ours when we have a meeting, I'm not anxious for anybody to lay out what the problems are. The problems are so well known by everybody here, that's a waste of time. So if you have, sort of 5 to 7 minutes for that person to talk, with one of the senior people in the administration or the president, what I've said is, I said you better have 5 tangible ideas of what ought to be done in the area that you're talking about. Just don't describe the problem. Don't hear yourself talk. Let's do this like it was at our business. And just how fast can you put things on the table? And those kind of meetings are always a lot of fun, whether they're in any of our organizations or in that kind of setting. And there's a whole bunch of to-dos after that, and then those get done after the meeting with follow-up. And it's actually very exciting.
So Tom, a family with Middle East background has a representative speaking at a national convention, puts on an inaugural. Did you ever think you'd be in that position? And why did you take on those responsibilities?
No, I never dreamed of it. I thought I'd be selling oranges in a grocery store if I did a good job, right, is where it would be. But, the responsibilities, I think the whole revolution that took place is really about what we all dream of, right? Is this ability to push through our own comfort barriers wherever they are and go to the next place. And this president represented that opportunity. I was gifted to take, the beginning part of the job of organizing the inauguration with a fabulous team, which is really a tribute to the system, more to the man. When you think about our country and this partisan transfer of power that happens seamlessly, it doesn't happen that way anywhere else. And I think that what Steve is suggesting as to how things going, that if people understood that the system, the bureaucracy is better than we think, and thank God it's there, right? Because presidents and administrations can change every 4 years, and so the bureaucracy is anticipating, saying we're not going to be so abrupt to do something that we just have to change again in 4 years. But having a president who can surround himself with people like Steve and Wilbur and Secretary Chow, the other people are here, and the generals, when we talk about generals, are pushing the aircraft carrier. they're just nudging it a bit. And sometimes unpredictability is the key of what you need.
Right.
Because the system devours predictability, and it will outweight you, and it will outsmart you. And for all of us who are sitting here looking for immediate benefits, it doesn't happen, right? I mean, entitlements are 90% of the budget. So when you cut through all this, and what we're feeling now with Congress, is no one man or one man team can make that happen. But having somebody who's unpredictable is working. So if you look at what happened really in foreign policy, right, and I think Secretary Ross was here yesterday talking about Syria, can you imagine between an entree and chocolate cake, that President Xi's sitting next to him saying, "Excuse me, President, before you take that chocolate cake, I'd like to tell you I just launched 59 missiles at Syria." I mean, he just must have lost his mind, right? It's never happened ever before. But that lack of predictability has gained respect. Every foreign leader has come to the table for him. And when you look at, and it's not President Obama's fault as to where we've ended up, it's a very complicated morass. But I just think the system for all of us is great. No matter what you think of this man or the administration, we're all now participating. News is 24/7. The beneficiary of the dismay between CNN and the president is Jeff Zucker, right? CNN ratings have never been better. We're all talking about freedom of speech. Everybody's involved in tax policy and healthcare policy and education policy. So out of this constant throwing arrows in the middle of serenity and calmness and bureaucracy, something great will happen. But it won't be as good as we think, and it won't be as bad as some people think, is my view.
Thank you, Tom. So I want to wrap up, if I could, here with yourself, Jonathan, Mitch, and John. The title of this session is Common Sense for Uncommon Investors. And Mitch, in your last comments implicitly, you were talking about that we should all understand the potential risk in ETFs and what's occurred today.
Right.
So in a very one or two sentences, tell us what common sense do you want people to walk out of here with? What is your wisdom that you want to share with them?
There's two elements. One relates to this conversation about the current government. Real estate, at least as epitomized by Donald Trump, has always been thought of in simplistic terms as, location, location, location. And I think what he has done with that is transformed it into another three words, which is jobs, jobs, jobs. So from my standpoint, common sense as an alternative asset manager means keeping track of, in the macro environment, as to whether this administration is able to find the points of leverage in the system and create those jobs. And I think it's all incumbent upon us as stewards of capital that we try to come up with the right balance between understanding our responsibilities to fit into that mantra, because there's a lot of hurting people out there. And, the study about single middle-aged white men either implicitly or explicitly offing themselves, sort of a Russian type of phenomenon, because of despair. And despair and anger are very related. So the jobs, jobs, jobs mantra is not just at the government level. As I say, cities are pursuing this in their different strategies, not waiting for the federal government. So, from the standpoint of alternative asset management, I think there's lots of opportunities to design capital structures, deleveraging opportunities, giving companies more flexibility. You can create that security for your investor that also gives companies the breathing room so they can also keep jobs or grow their company responsibly. And I think that's in keeping with what's been said before.
So Mitch, just one comment on that, I think. For the general LP, foundation, et cetera, to understand these complexities, et cetera, it's pretty hard for them to do without a full-time staff. And that's why you want me to give you a call, right?
Yes.
Thank you. Okay. Jonathan, what wisdom, I think maybe more than any other private equity firm, your ability to transition from essentially retail to services has been an amazing thing. Very few people are able to really transform their strategy. What going away wisdom do you want people to take with them here today?
Well, look, I mean, we're investors. We're not economists, politicians. Our job is to take our limited partners' money and take $1 and hopefully turn it into $2 to $3. Our core investment philosophies have remained the same for 30 years, which I sketched out earlier. But we live in a time of such rapid and dramatic change, more so than ever in our investing career. So you have to look behind you. You have to look around the corners. You can't take a nap. Everyone is being disrupted. So it's probably the most exciting but the most treacherous time to be an investor in my view in the past 30 years. And it also means along the way, if you have an investment and the thesis was great when you made it and you're worried about change, don't forget to sell, because we are investors and we're paid to sell and realize gains. So we try to figure out what's coming on around the corner, and overall we're in a pretty okay economy. The consumer is spending, the GDP is growing. We've all been a huge beneficiary of unbelievably user-friendly capital markets. The cost of the debt and the debt technology has probably made us look a little better than we are, and we'll continue to use that aggressively as long as that continues. When we started with Mike 30 years ago, debt was 12, 14%. Covenants, you couldn't go to you couldn't move without talking to your lenders. Today, you don't really have to talk to your lenders because there's nothing in your contract except pay interest when due and pay principal when due. So it's a fantasy it's a wonderful environment. Probably won't endure forever. So we continue to benefit from the capital markets opportunities and continue to be really, neurotic and worried and figure out how to deploy our investors' capital in this exciting world we live in.
You're the cleanup hitter.
Yeah, just one comment. I think the environment here has changed quite a bit. I think from an investor point of view, the bond surrogate trade is over. Interest rates have been the lows in history. That's over. And I think what we'll see in the equity markets, we're no longer in this low, very low deflationary environment. We'll see active management in the equity space come back because of that, because it's a very different environment that we're going to find ourselves going forward. Hopefully, fiscal policy is going to work here, because we've had no good fiscal policy for 10 years here, and everybody's so focused on monetary policy that now with the proper fiscal policy, we'll see active management come back, we'll see growth come back, and obviously a little inflation. So I think that's positive.
Well, thank you very much, and we are honored to have heard common sense today from uncommon investors. Thank you.